The story of global finance is a recurring drama of boom and bust, where success often sows the seeds of its own destruction. Few periods illustrate this truth as vividly as the 3 decades leading up to 1997, a time celebrated as the golden age of the East Asian economies. For a generation, the nations of East Asia, from Thailand and Indonesia to Malaysia and the Republic of Korea, were heralded by the world as the architects of an economic miracle. Their performance was truly extraordinary. Rapid and robust growth that seemed to defy the limits of industrialization, sustained low inflation, and remarkable macroeconomic stability. They boasted strong fiscal positions, high domestic saving rates, and dynamic, thriving export sectors. This stellar track record made them irresistible to the global financial system. Capital, abundant and eager for high returns, flowed into these markets in a torrent. Until 1997, nearly half of all capital directed toward the developing world was pouring into East Asia. This overwhelming success bred not caution, but a profound and dangerous sense of hubris and policy denial. Authorities in Seoul, Bangkok, and Jakarta were convinced their nations were fundamentally different. They believed themselves immune to the crises that had scarred Latin America in the 1980s, primarily because they lacked the structural problems of heavy public debt and unchecked monetary expansion. This powerful psychological barrier prevented policymakers from seeing, let alone seriously addressing, the structural weaknesses that were quietly accumulating beneath the surface of the macroeconomic stability. The flood of foreign capital, however, was clearly fueling significant domestic overheating. The evidence was visible in the streets and on the financial screens, heavily inflated property values and soaring stock markets. While the eventual crisis caught the public and international observers by surprise, sophisticated domestic actors were already losing confidence. Equity markets, often regarded as a crucial barometer of economic health and an early warning system, signaled deep distress long before the currency collapse. By the end of 1997, stock prices in countries like Thailand and South Korea had already fallen by over 60% from their pre-crisis peaks, a clear indication that massive asset price bubbles had been inflating and were now beginning to burst. This sustained decline generated potent negative wealth effects and severely impaired the collateral value of bank loans, thus acting as a crucial accelerant to the broader financial distress. Even when the International Monetary Fund, in early 1997, issued stark warnings to the Thai government of an impending foreign exchange crisis, the local authorities found it politically and psychologically difficult to grasp the seriousness of the emerging problems until the tipping point had passed. This sequence of events delivers a sobering lesson. Rapid economic growth, when it fosters policy arrogance and delays crucial structural adjustments, becomes a dangerous precursor to systemic failure. The miracle was, in fact, an illusion masking fundamental fragility. Below the celebrated veneer of macroeconomic stability lay profound institutional deficiencies. The true crisis was rooted not in national debt, but in a catastrophic collapse of corporate and financial sector governance, a system defined and driven by what became known as crony capitalism. This system was an enabling structure. It fostered implicit government guarantees for large firms and tolerated lax banking supervision, which collectively led to appallingly poor decisions regarding credit allocation within the region's banking-dominated financial systems. In Korea, the financial architecture was severely compromised by excessive lending to massive traded sector conglomerates known as ***. These sprawling industrial empires often effectively controlled some private banks, granting them privileged, almost unlimited access to credit. This arrangement exacerbated the problem of moral hazard. Believing themselves too large to fail, the **** engaged in unrestrained market expansion, excessive debt financing, and boundless capacity build-up, recklessly inflicting enormous damage on the national economy's balance sheet. Driven by international pressure for integration, East Asian nations pursued financial and capital market liberalization in the early 1990s. However, this liberalization was fatally flawed in its sequencing and execution. When this newfound freedom was coupled with persistently weak financial supervision and the deep, shared expectation that the government would always protect the largest firms from bankruptcy. It created an optimal environment for the accumulation of systemic risk. Non-banking financial institutions, NBFI, often owned or controlled by the Keebles themselves, gained freedom to secure funding from international markets. They attracted considerable foreign capital by offering returns higher than the market, all while conducting virtually no adequate risk assessment. Traditional banks, content to lend to their Korean counterparts, consequently had little incentive to scrutinize the high risk of default or poor corporate governance within these conglomerates. The failure of basic prudential requirements, including lax loan classification practices and the prevalence of connected lending, loans made to major shareholders, meant that regulatory deficiency was the primary enabler of the ensuing credit boom and asset bubble. The problem lay not so much in the lack of transparency of borrowing firms, but in the complete lack of scrutiny and due diligence by the lending institutions. A pivotal macroeconomic policy choice that exponentially exacerbated the structural fragility was the management of exchange rates. For years, these nations maintained prolonged pegged exchange rates, often fixed firmly against the US dollar. This policy choice, viewed by many analysts as an unsustainable market distortion, was widely perceived as an implicit government guarantee of currency value. This perception provided a cheap, de facto subsidy against foreign exchange risk. It actively encouraged excessive external borrowing by both financial institutions and corporate firms. Domestic companies, seeking to bypass capital scarcity at home, began borrowing dollars at the much lower international interest rates, operating under the dangerous assumption that the peg would hold indefinitely. This decision created a massive, unhedged exposure to foreign currency risk across the financial and corporate sectors, a ticking time bomb of dollar-denominated liabilities. Furthermore, the fixed exchange rate regime severely constrained the ability of monetary authorities to use domestic interest rates to effectively cool down the obvious overheating pressures in the domestic economy. By subsidizing foreign currency debt, this policy choice ensured that the eventual failure of local banking supervision and corporate governance would inevitably metastasize into a balance of payments crisis, directly linking the fate of vulnerable domestic balance sheets to the volatile whims of the foreign exchange market. The groundwork for catastrophic collapse had been meticulously laid. The unparalleled speed and severity of the crisis stemmed directly from the nature of the external financing. The core vulnerability resided not merely in the overall size of the external debt, but in its toxic composition, short-term maturity combined with foreign currency denomination. This created a massive and fatal maturity and currency mismatch in the assets and liabilities of banks and corporate firms across the region. Foreign debt-to-GDP ratios exploded in the most affected regions. In the four largest economies of the Association of Southeast Asian Nations, ASEAN, these ratios surged from an average of $100 in the early 1990s to $167 by 1996, climbing beyond $180 during the worst of the crisis. Crucially, the crisis was overwhelmingly fueled by this excessive private sector external borrowing, not reckless government spending. The initial signs of corporate insolvency began to emerge months before the currency crisis, providing a clear indication of liquidity stress. In Thailand, the company Somprasong became the first major firm to miss its repayment on foreign debt on February 5, 1997. This default was a bellwether, signaling the corporate sector's broad, impending inability to service its dollar obligations. Because of the implicit guarantees embedded in the Crony capitalist system, this mass private debt failure was immediately and catastrophically transformed into a sovereign liability crisis, forcing governments to frantically scramble for foreign currency reserves to protect the financial system from utter collapse. The full-blown financial catastrophe was triggered by coordinated, ferocious speculative attacks against the Thai Baht, an event that became known as the Tom Yum Kung crisis. Speculation, in this context, involves the massive sale of a domestic currency in the expectation, or in the deliberate attempt to provoke, a sharp depreciation. Thailand faced a sustained series of these attacks. The Bank of Thailand, BOT, mounted a vigorous defense, attempting to maintain the currency peg by borrowing foreign reserves and dramatically hiking overnight interest rates. This defense, though lasting 6 weeks, required extremely high interest rates and the physical segmentation of onshore and offshore currency markets. This policy choice created an immediate and devastating policy conflict. The sky-high interest rates, intended to defend the peg and stabilize investor confidence, simultaneously imposed huge, crushing costs on domestic Thai businesses, particularly importers and those who had borrowed dollars. The interest rate spike crippled local borrowers, driving the already rising non-performing loan (NPL) problem into an immediate, existential crisis. The attempt to quell the currency crisis ultimately intensified the domestic financial crisis, creating massive damage before the currency had even collapsed. Ultimately, the defense could not be sustained due to the crippling costs and the rapid depletion of foreign currency reserves, forcing the Thai government to float the baht on July 2, 1997. The peg was abandoned. The forced float initiated an instantaneous international chain reaction. Devaluations swiftly followed in Malaysia, the Philippines, Indonesia, and South Korea. While trade links played a supporting role, cheaper Thai exports reduced demand for competing goods from neighbors like Indonesia. The primary channel of contagion was financial panic. The developments in Thailand caused international investors to look more critically at vulnerabilities elsewhere in the region that they had previously ignored. This sudden, collective reassessment of risk, a shift in sentiment from reckless optimism to existential fear, led to a generalized, catastrophic withdrawal of capital. This demonstrated a chilling reality. Systemic crises are often driven by sentiment, herd behavior, and fear rather than a gradual, fundamental deterioration. The swiftness and severity of the transmission mechanism were unprecedented in modern financial history. The crisis rapidly transitioned from a currency problem to a full-blown financial collapse and, finally, a deep, pervasive recession. South Korea, Indonesia, and Thailand were the most affected nations, but the true hallmark of this contagion phase was the sudden stop, a catastrophic, abrupt reversal of capital flows. Across East Asia, capital inflows either slowed dramatically or reversed direction entirely, transforming a debt management problem into a severe, paralyzing liquidity crisis that instantly drove countries to seek intervention from international bodies. The economic turmoil rapidly spilled over far beyond the Asian region, threatening to undo the economic achievements of developing countries globally. Emerging market economies in Eastern Europe and Latin America, including Brazil and Russia, faced significant balance of payments pressures in 1998, reflecting the growing global interdependence and the overwhelming threat of contagion. The world learned a hard lesson. A structural failure in one major emerging market region could rapidly translate into systemic global risk. The financial collapse quickly translated into a severe real economic recession, the depth of which was comparable to the economic Great Depression of the 1930s. In 1998, real GDP contracted significantly across the core crisis economies. Indonesia suffered the most profound setback, with its GDP shrinking by nearly 14%. Industrial production went into a tailspin, falling almost 19% in Indonesia and over 11% in both Thailand and Malaysia in the year following their currency floats. The most devastating mechanism of the crisis was the translation of foreign exchange debt into massive domestic insolvency. When currencies depreciated precipitously, the Malaysian ringgit, for example, shrank nearly 50%, the domestic currency cost of servicing dollar debt skyrocketed overnight. This immediately shattered the balance sheets of corporate entities, leading to mass bankruptcies and an unstoppable surge in non-performing loans, NPLs. NPL ratios peaked at a shocking $50 in Thailand and $25 in Indonesia. The currency crisis thus triggered a banking crisis, which then morphed into a full-scale economic and social crisis. The human cost was staggering and immediate. Unemployment rates more than tripled in South Korea and more than doubled in Indonesia between 1997 and 1998. Real earnings per worker declined drastically, falling by over $20 in Indonesia. The poverty rate in Indonesia nearly doubled in just 2 years. This rapid, catastrophic contraction resulted in an immediate and total loss of public confidence in established regimes. In Indonesia, the economic distress triggered widespread social unrest and mass riots in May 1998, which were instrumental in forcing the resignation of President Suharto, ending his 32-year authoritarian rule. The fact that a sudden financial shock could rapidly metastasize into political crisis and regime change demonstrated the profound and often violent political implications of financial globalization. The magnitude of these real economic declines underscored the observation that the crisis was far more than a simple currency misalignment. It was a devastating systemic failure. In affected countries, the crisis came to be known, tellingly, as the IMF crisis, a term symbolizing the painful loss of sovereign economic control to international dictates. In the face of devastating capital flight and a terrifying contagion risk, the International Monetary Fund, IMF, and the international community were forced to intervene, mobilizing rescue packages totaling nearly $100 billion for Thailand, Indonesia, and Korea, the largest loans in the fund's history. The basic strategy was twofold and urgent. First, to rebuild official reserve cushions to immediately stabilize the collapsing currency value, and second, to impose rigorous structural adjustment policies that would address the root causes of the crisis, the cronyism and structural weakness that had enabled the collapse. Aid was strictly conditional on these painful domestic policy reforms. The IMF mandated a structural adjustment package, SAP, focusing immediate efforts on firm monetary policy, specifically extremely high interest rates, to resist excessive currency depreciation and restore market confidence. The goal was to stabilize the external foreign exchange market while forcing the countries to confront the structural deficiencies that the collapse had so brutally exposed. The conditionality imposed by the IMF quickly became the single most controversial aspect of the crisis response. Critics, most notably Joseph Stiglitz, then chief economist at the World Bank, were profoundly critical of the IMF's alleged market fundamentalism. He and others argued that the IMF's policies had, in essence, encouraged the very financial liberalization and high domestic interest rates that compounded the crisis. The core criticism leveled against the fund was that its mandated policies, restrictive fiscal and monetary measures, were too austere and aggressively deflationary, effectively turning a temporary economic slowdown into a deep, agonizing recession. This highlights a fundamental, tragic dilemma in global crisis management. The high interest rates required to restore external investor confidence and halt capital flight simultaneously guaranteed the destruction of domestic balance sheets already strained by the sharp rise in the domestic currency value of dollar debt. The policy necessary for external stability amplified internal economic suffering. Furthermore, the IMF was criticized for imposing an excessive number of structural conditions that were not always immediately necessary for financial stabilization. Policy experts argued that the fund should have focused on a leaner, more immediate agenda of core monetary, fiscal, and banking reforms, rather than leveraging the crisis to force deep, long-term structural changes across society. Despite these criticisms, the necessity for structural reform was undeniable. The IMF's conditionality provided crucial external leverage that allowed domestic reformers to undertake painful but necessary changes, such as overhauling financial sector regulation and NPL resolution frameworks, which they had previously been unable to implement due to entrenched vested interests and political inertia. Malaysia, one of the heavily affected nations, chose a radically different path, a direct rejection of the IMF's orthodox prescription. Prime Minister Mahathir Mohamad eschewed international assistance and implemented temporary capital controls, pegging the ringgit back to the US dollar in September 1998, following earlier restrictive measures. This heterodox approach was a gamble, designed to shield the economy from speculative external pressures and restore monetary sovereignty. The goal was to permit the government to immediately lower interest rates and pursue a domestic-led recovery, policies fundamentally incompatible with IMF conditionality. The outcome demonstrated that strict orthodoxy was not the single path to stabilization. Malaysia avoided the severe bank runs experienced in Thailand, Korea, and Indonesia, partly by issuing an early and credible guarantee of bank deposits. The use of controls allowed policymakers to regain policy space, avoiding the extreme rate hikes that crippled domestic businesses elsewhere. The country established a dedicated recapitalization agency, Dana Model, which swiftly restored the capital levels of domestic banks, leading to a faster and smoother recapitalization process compared to its neighbors who relied on the IMF's slower, more condition-laden approach. Despite the dramatic policy divergence on interest rates and exchange regimes, all the affected countries ultimately converged on the necessity of structural cleanup. All crisis nations relied on systematic resolution mechanisms, particularly the utilization of asset management companies, AMCs, to manage and dispose of the massive stock of NPLs and restore the solvency of the financial system. This common reliance on structural reform demonstrated a core lesson: that long-term recovery depended less on the short-term monetary toolset and more on the political commitment to fixing the underlying balance sheet problems. The intense, shared pain of the 1997 crisis spurred fundamental, far-reaching structural and regulatory transformations across East Asia. In a concerted response, many countries adopted more flexible exchange rate systems, significantly reduced their reliance on volatile external debt, particularly short-term dollar borrowing, overhauled financial sector regulation and supervision, and decisively resolved the private sector debt overhang. These concerted efforts led to a marked improvement in regional financial resilience. For instance, by 2002, the critical maturity and currency mismatch in Thailand's commercial banks had largely disappeared. These stronger foundations enabled Asia to weather the 2008 global financial crisis far better than many developed nations, serving as a model of crisis-induced reform. Concurrently, the international financial system evolved, improving crisis management protocols and recognizing the need for greater transparency and consistency between policy frameworks. Despite 2 decades of reform and the hard-won experience of the late 90s, the core vulnerabilities of emerging market economies, EMDE, to external shocks persist, providing a haunting echo of the 1997 crisis dynamics. Contemporary EMDE are, on average, more highly indebted than their predecessors, carrying elevated levels of government and private debt, often still denominated in foreign currency. They rely heavily on volatile short-term portfolio and bank flows, hot money, to finance deficits. The hyperconnected nature of the global financial system ensures that stability in IMDE remains acutely dependent on external monetary policy. The tightening of monetary conditions in developed economies, particularly interest rate hikes by the US Federal Reserve, remains a critical source of financial vulnerability. Historically, such tightening is associated with capital withdrawal from IMDE, leading to currency depreciation and potential financial instability, the modern manifestation of the sudden stop. To counteract capital outflows, IMDE central banks are often forced to raise their own domestic policy rates, reviving the agonizing conflict between external stability and domestic growth, a policy dilemma identical to the one that crippled Thailand in 1997. The persistence of foreign currency debt exposures means that any sudden depreciation still risks triggering the destructive debt translation mechanism observed in the Asian financial crisis, highlighting that balance sheet weaknesses are exceptionally difficult to eradicate. A core lesson remains: the necessity of ensuring consistency among exchange rate, monetary, and regulatory policies, demanding continuous vigilance in maintaining financial condition transparency and decisive policy action. Post-1997 and post-2008 reforms have focused intensely and successfully on strengthening the traditional commercial banking sector. But systemic risk has proven capable of migration. It does not disappear. It simply finds new, less regulated avenues. One of the most critical contemporary threats that mirrors the structural failures of 1997 is the rise of the non-bank financial intermediaries, NBFI, often referred to as the shadow banking sector. Assets held by NBFI have grown significantly relative to banks globally. The precise systemic structure that created instability in Korea, where risk accumulated in lightly regulated, non-bank institutions controlled by conglomerates, has been globally replicated in new forms. The IMF now cautions that the growing interconnectedness between banks and NBFI raises the likelihood of abrupt, widespread market corrections. These sectors are so deeply interwoven that banks remain exposed to credit and funding risks that appear, on the surface, to have migrated to NBFI. This complex relationship suggests that risk propagation and amplification are highly possible, even inevitable. Since IMDE are particularly vulnerable to sudden capital flight and the sudden stop, the failure to treat banks and NBFI holistically means the fundamental structural challenge of regulatory arbitrage persists. This migration of risk confirms a chilling truth: the potential for a sudden, cascading liquidity shock, akin to the 1997 contagion, remains an intrinsic systemic threat in the contemporary, hyperconnected financial world. The crucible of capital continues to test the resolve and resilience of emerging markets, a test they must face, prepared or not, in the shadow of the Asian miracle and its abrupt, painful end.